Investment fraud is among the most prevalent crimes in the financial sector, making it one of the most controversial and noticeable incidents in the business and economic world. These scams typically involve deceiving investors and stealing their money with false promises of high returns or fictitious investment opportunities. In this article, we will examine 10 of the most prominent investment fraud cases in history, where scammers manipulated and deceived investors for their own personal gain. Why do people fall victim to these scams? The dream of getting rich quick is arguably the primary motivator for most scams that target individuals with limited knowledge of investing and wealth creation. Based on our experience with scam platforms and the investigations and complaints reviewed by our legal compliance and verification teams, the dream of quick riches has proven to be the key factor that allows most scammers to easily ensnare their victims. In this context, scammers rely on promoting false and enticing promises to their victims, such as the possibility of acquiring great wealth by signing up for bogus investment offers like monthly packages, or promoting a fake project through referrals and other dubious methods. Scammers exploit their victims' aspirations for quick riches and financial freedom, thus placing them under psychological pressure to make hasty decisions without independent thought or consulting others. In doing so, these scammers take advantage of the victim's emotional vulnerability and eagerness to achieve their dreams, obscuring the true nature of their supposed investment opportunities to push the victims into making poor decisions without any critical thinking. Scammers also exploit the difficult economic circumstances people are facing to promote fictitious opportunities for quick profits, relying on motivational phrases that exploit their needs, such as promises of owning a private car, obtaining vast sums of money in the bank, and FOLF. 2. Bernard Ebius. Bernard Ebius is the former CEO of WorldCom, the center of one of the most notorious financial frauds in U.S. history. Ebius managed WorldCom through a series of acquisitions and implemented a financial restructuring strategy to make the company appear financially sound. He used these tactics to manipulate financial figures and conceal the company's massive debt resulting from excessive purchases and unprofitable investments. Thanks to internal disclosures and financial investigations, authorities uncovered the shocking truth behind Ebius' operations. He had inflated the value of investment assets by millions of dollars and falsified financial reports, causing significant losses for shareholders. WorldCom's stock price plummeted from $64 per share to just $1 after the fraudulent activities were exposed, resulting in shareholders losing approximately $100 billion. In 2005, Ebius was convicted of accounting fraud and financial manipulation, and was charged with conspiracy to inflate the value of financial assets and conceal debt. He was sentenced to 25 years in prison, which underscored the seriousness of his crimes and their damaging impact on the economy and investor confidence. Jordan Belfort. The Jordan Belfort scheme, also known as the Wolf of Wall Street, is one of the most notorious frauds and manipulations in the history of the financial markets. Jordan Belfort was an American investor and stockbroker who became infamous for his unethical and illegal practices during the 1990s. Belfort worked as a stockbroker on Wall Street and gained notoriety for his unethical methods of attracting investors and generating quick profits. Belfort and his organization employed numerous fraudulent and manipulative tactics, including setting up shell companies, providing inaccurate investment recommendations to clients, and using stock manipulation tactics that resulted in losses of $200 million for his shareholders. In 1998, Belfort was convicted of fraud and money laundering and sentenced to 22 months in prison and ordered to pay a $100 million fine. After his release, Belfort started a new life as an inspirational speaker and author, lecturing on business ethics and financial transactions. Jordan Belfort's story and his fraudulent scheme were depicted in the 2013 film, The Wolf of Wall Street, starring Leonardo DiCaprio as Belfort. James Paul Lewis Jr. The James Paul Lewis Jr. scheme is one of the world's most notorious frauds. James Paul Lewis Jr. was responsible for a systematic fraud that lasted for 2 decades until his arrest and trial in Texas, USA, in 2006. Lewis used an elaborate pyramid scheme to deceive investors, relying on a referral program to attract new investors with empty promises of high returns from his projects. In 2003, the Securities and Exchange Commission, SEC, filed a complaint alleging that Lewis had committed fraud against investors in the securities markets. According to records, he misappropriated investors' funds for foreign exchange trading and to purchase luxury cars and expensive jewelry. James Paul was found guilty in 2006, sentenced to 30 years in prison, and ordered to pay $156 million in compensation to 5. Michael de Guzman. Michael de Guzman is a figure associated with the Pre-X Minerals scandal of 1997. De Guzman was an employee of the company and played a key role in falsifying sample results to show the presence of vast quantities of gold at a mine in the jungles of Borneo between 1993 and 1996. The scandal began when Pre-X Minerals announced significant gold discoveries in Indonesia. De Guzman presented several samples that appeared to show substantial gold deposits, causing the company's stock to soar to record highs of nearly $6 billion. However, it was later revealed that these samples were entirely fabricated. No real gold was found at the mine, and the entire announcement was proven to be a scam. Following the exposure of this fraud, Pre-X Minerals' stock price plummeted to zero. This scandal severely damaged the company's reputation and caused enormous financial losses for its investors. Sam Israel. Sam Israel was convicted of fraud and financial market manipulation after leading a major investment scheme called the Bayou Hedge Fund Group, which he promoted as an investment fund that would generate huge returns for investors. Israel excelled at falsifying information and manipulating financial data to attract more investors and convince them to put their money into the fund. In reality, however, the money he collected was used to cover his personal losses and finance his lavish lifestyle. After a period of manipulation and deception, local authorities uncovered Israel's financial crimes, and he was convicted of fraud and financial market manipulation, receiving a 20-year prison sentence and a $200 million fine. Joseph Narchio. In 2007, Joseph Narchio, the former CEO of Quest Communications, was implicated in the company's largest financial fraud. He inflated revenue and illegally manipulated company stock to personally gain an estimated $52 million. Investigations revealed Narchio's direct involvement in the scheme, leading to his conviction on 19 counts of financial fraud. He was sentenced to 6 years in prison, ordered to repay the illegally obtained funds, and fined $19 million. This came after Barry Minko. Barry Minko, born in 1966, is an American businessman known for his pyramid scheme. As a teenager, Minko founded ZZZZ Best, a carpet cleaning company that initially achieved great success. However, he quickly exploited this success to carry out a massive fraudulent scheme. In December 1986, when Minko was 19 years old, he took his company public, raising its market capitalization to over $200 million. It was later discovered that Minko had used fraudulent techniques, creating fictitious operations and falsifying the company's financial statements to attract investors and inflate the stock price. However, suspicious amounts on customer invoices began to raise concerns, leading to an investigation into the company and its true market value. The investigation revealed that Minko's revenue was fabricated. Ultimately, Minko was convicted on 57 counts of fraud, forgery, and money laundering, and sentenced to 25 years in prison, in addition to being ordered to pay $26 million in restitution. This ruling was part of efforts to combat financial crime and protect investors' rights. Kenneth Lay and Jeffrey Skilling. The early 21st century witnessed one of the biggest financial scandals in American history, the Enron scandal. This company, once considered a symbol of success in the energy sector, engaged in widespread fraud. It inflated its profits and illegally concealed its debts, leading to its sudden collapse in 2001. Kenneth Lay and Jeffrey Skilling, the company's founder and former CEO, respectively, were the masterminds behind these fraudulent schemes. Their corruption resulted in investors losing billions of dollars, an estimated $74 billion, after Enron's stock price plummeted from $90 to less than $1 in just 1 year. Lay and Skilling were tried and sentenced to prison for fraud, forgery, and violating financial laws. However, by the time of sentencing, Lay had died of a heart attack. Skilling was sentenced to 24 years in prison and fined $45 million. Bernie Madoff. The 10th and final case concerns Bernie Madoff, considered one of the most notorious fraudsters in investment history. Born Bernard Lawrence Madoff in 1938, he founded an investment company bearing his name, Bernie Madoff Investment